Post the Q2 result season, we've seen a whole host of brokerages that have gone in and tweaked their Nifty earnings expectations, Nifty EPS estimates, and this is mainly on the back of the fact that whether earnings have been misses or beats. Today we have two important brokerages that have weighed in as far as how exactly Q2 fared for the entire corporate universe, especially the Nifty. Now when you're talking about the two brokerages today that we are looking at, CLSA and Nomura are the ones we would be highlighting today. When it comes to CLSA, Vikas, Kumar, Jain of CLSA has highlighted that PSU oil and gas, metals and media actually had a very good quarter. On the other hand, consumer staples, healthcare and property missed CLSA estimates. So CLSA analysts have gone ahead and raised their earnings estimates for 54% of their coverage universe, while downgrades as far as their coverage universe is concerned came in for around 34% of the total covered stocks. Overall, this has led to a 4% upgrade in FY22 EPS estimate and a 3% upgrade as far as their FY23 EPS estimate is concerned. Now what has happened? There have been cuts taken in healthcare and consumer discretionary. However, this has been offset by the fact that there have been upgrades that have been taken as far as the PSU oil and gas as well as metal companies are concerned. Now, consensus Nifty EPS was cut by 2% for FY22. It was lifted by 3% for FY23 as far as CLSA is concerned. Now, when we are coming to Nomura, Nomura says that actually they are a little concerned and they've highlighted two key factors that are slightly concerning going forward and could pose a risk to Nifty earnings as well as corporate India earnings. What are the two worries? Number one, higher cost. We have seen inflation across the spectrum, and this is something that worries Nomura. Along with that, a slowdown in demand is something that they are witnessing, and again, this is something that they highlight could pose a risk to current earnings expectations. Q2 FY22 corporate earnings were almost 4.6% ahead of street expectations as far as an aggregate level basis was concerned. Net earnings for 136 companies that they cover aggregated and recorded a 38% year-on-year growth. Earnings ahead as far as consumer durables were concerned, healthcare is concerned, real estate is concerned, according to Nomura's estimates, and auto, staples and utilities missed the consensus estimates when compared to the Nomura estimates. FY22 earnings were revised up by 1.2% and FY23 earnings were lifted up by almost 2.9%. So overall, when you're talking about how exactly brokerages have reacted, it's been a good earnings season, but highlighting some worries, especially inflation and demand slowdown. And these are key factors that we would be watching out for going ahead.